Hi everyone, I'm Vaibhav and today I'm presenting my final report for trading in financial markets. My research focuses on a comprehensive analysis in the exchange trade funds and the mutual funds. Especially, I tracked two ETFs, SPY and Sharia compliance SPUS against two mutual funds, VFIAX and AMANX. Both are US based, all four are US based stocks to show how much their structures influence the performance, liquidity, and the manager's behavior. So, at first, we'll look at the price data. The price data I have choose is basically of 1 year in two halves. The first half is from March 2025 to October 2025, and the next is from October 2025 to March 2026. So this is the price data, and these are the returns. And now we will look at the risk summary. The risk and return summary. Looking at the risk summary, the results were telling SPUS emerged as a top performer with an average return of approximately 19.38 throughout. It carried a high standard deviation of 1.29. Contracts with the mutual funds of AMANX showed much lower returns at higher volatility during the second half of the study, while SPY and Vanguard mutual funds VFIAX performed almost identically in the terms of Sharpe ratio. The infrared nature of ETFs allowed for more dynamic risk management and compared to the end of the day NAV of the mutual funds. In the next, the liquidity analysis. The liquidity is where the two categories truly diversified. My analysis showed the SPY maintenance very high liquidity with a razor thin bid ask spread of 0.01 with an average of daily volume of 80 million shares. On the other hand, the mutual funds like VFIAX rely on the fully redemption at the end of the day. For a trader, the ETF provided far superior price transparency and the ability to exit the position instantly during the market swings, which is a critical advantage for a volatile period. And the next is our tournament behavior. In the tournament behavior, a key part of the study was the testing the tournament behavior, the theory that the funds manager take excessive risk in the second half of the year climb rankings. My data showed that the SPUS took the top rank in the first half of 24.12% return. Interestingly, we saw increased volatility in the second half for several funds, suggesting the managers may indeed shift their risk profiles to maintain their winner status to catch up from losers. And at the last, my trading simulation. In the trading simulation, to test these insights, I executed 12 trade simulation on a trading platform. I utilized momentum rebound and depth buying strategies. For example, in the trade 5, I captured 1.41% of the gains and SPUS by anticipating my price recovery. However, I also experienced the reality of market impact and slippage, especially in more. No, however, in the specialized funds, overall the project demonstrates the mutual funds offer stability. ETFs provide the liquidity transparency, especially for the active trading strategy to collect data. Basically, I use the website investing.com, and let's say I want the historic data of a particular ETF or a stock. Let's say I'll search SPY. I'll go to that ETF and then search for historic data. After clicking on historic data, it will show me what the previous prices were, and according to this I will choose my dates for which date particularly I want the data for, and then click on apply. It will give me the data for that particular days, and I can just download it from here. So basically, I use the buy right strategy where I buy the stock and sell at the call option on the same stock to earn a premium income. What I did was I selected 5 stocks: JP Morgan, Walmart, AMD, Johnson & Johnson, Chevron, and 2 indices, SP500 and Nasdaq 100. For each trade, I bought 100 share and then sold at slightly out of the money call option. For example, in JP Morgan, I bought the stock around 297, 100 shares. The strike price was 305 and the premium share was 3.5. The expiry was 398 and the stock profit and loss was around 3808 due to the due to the buy and ride the sell strategy. The premium income was 350, from which I made a total loss of 458. And according to this, I repeatedly do this process for across 12 times across 2 weeks, adjusting strike price slightly above the buying price to balance the risk and return. My idea was not to maximize capital gains but to generate a consistent income and reduce the downside risk. Now the result: stock only strategy gave me a loss about 3781, but with BWS I made a profit of $159. The major difference came from 3940, the premium income. Also, I had 7 winning trades out of 12, so around 58% of the win rate. So what I observed, even when I was wrong on the price direction, I still made money to reduce losses because the premium, that's the biggest advantage of BWS. Bond portfolio, I focus on managing interest rates risk in 2026 environment with the inflation is rising and the yield curve is upward sloping. I constructed a portfolio across 2 years, 5 years, 10 years, and around 30 years, equal 20% of the weightage to ensure the diversification. For each 2 years, I had duration of around 1.9, and for 30 years it's a bit more high, which is around 19.5, showing significantly higher sensitivity to the interest rate changes. After combining all the bonds, my portfolio duration came around 6.28, and my portfolio modified duration came around 6.53, and my portfolio convexity around 196. After the adjustment, the actual loss reduces to 5.5, and showing the importance of convexity in the risk management. Based on this, I made a strategic decision. In current conditions of rising inflation, I avoided heavy exposure to the long-term bonds, initially focused more on mid-term bonds like 5 to 10 years for stability, and I planned to gradually increase 30 years exposure later when the rates cuts are expected. I also applied a mix of strategy, buy and hold for stability, duration matching for risk control, and active adjustments on the market expectations. So overall, my portfolio shows the bond still works or 2026, but only if you actively manage duration, diversified maturities, and adapt to interest rate movements. In conclusion, bond investment today is not about timing the markets, it's about managing the risk intelligently. So thank you.